Well, welcome to the Chaim Investment Advisors podcast. Exciting times. We have Lillian and Pablo here today, and I will give Lillian's bio because it's the first time she has been on here with us, and you guys are used to hearing me and Pablo talk about all kinds of stuff. But Lillian is the host of the Oh My Dollar podcast, which is also an awesome podcast that you should definitely check out, and probably most of you listen to. And she also, she does financial advice radio show, an international public speaker. She's got a reputation for talking about money in a way that is not boring, and that it makes her probably a great guest today because that is kind of
we don't want boring podcasts.
Yeah, that's why you guys are listening to this.
Some people strive for a boring podcast, so
Yeah, that's true. Well, if that's what you came for, I got bad news for you today.
Right. This has been the theme of the summer. Has been very barn burner content from Chaim Investment Advisors, including our anti-capitalist investor talking series, which is been interesting, and you guys can check that out. But Lillian, long background in all kinds of areas of talking about money, and excited to have her on today, where we're going to talk about recession, and she also has got lots of requests from elsewhere to talk about that. So yes, this will be a good conversation. We all have lots to say about, are we in a recession? What is stagflation? Do we have stagflation? We're going to cover it all. And we will start with the big question, which is, are we in a recession? That's like literally the most asked question I've dealt with simultaneously in years as an advisor.
I'm going to say yes.
The answer is the most typical economist answer, but it depends. because economists, here's the classic answer to that question, which is that economists, as much as they like to pretend that they predict the future, in fact, what they do is interpret the past data to decide what already happened. And the economics definition of a recession is 2 consecutive quarters of negative growth. And no, we haven't hit that yet. But guess what? That could mean that we're in it right now, and it started, but we won't know until later. And I think Pablo has a lot of points about the fact that there seems to be a lot of people claiming that we're not in it because we don't have the data that we are currently yet, but we have a lot of indicators that we might already be in.
If you're looking, if you see smoke, there might be fire there sometimes.
Well, we will show people some today.
Some smoke,
Pablo, when you're looking for what indicators for a recession, what are the kind of the typical things that we add together to see if there is a recession? Because I think recession is something we viscerally experience just as humans existing in an economy. But there's also data points that we look towards if we're trying to make predictions from an investment perspective.
Totally. I think there's a couple things we can look at. So we can look at real growth, and we can look at spending. I think those are 2 great indicators to look at. So looking at real growth, especially when you add in, and I think that's some of the difficulty here is because we have a lot of inflation, and you get a lot of numbers back about what is the real inflation number. And there's a lot of massaging of the inflation numbers because no one wants to hear that there's a huge amount of inflation, right? I think Chaim had a couple Instagram posts about that. They're saying 9%, but where's the real inflation number at, And so I think that's the first part, right? Just to even get the real number of the growth. And I think that the second piece, which is kind of a little bit easier in layman's terms, is to look at who's spending money and where capital is going, right? Whenever there's a real recession, you see a lot of capital being withheld, that people aren't trying to really grow. And I think that sort of off right before the podcast, we were discussing this sort of K-shaped recovery, which makes it even more nuanced because sure, some people are spending money. Some people are continuing to spend money, and there's parts of the economy that are still growing. But is that the experience of a majority of people. And I don't know if that's the case, really. So that's kind of like my gripe with not all economists, also just some economists, and mostly the Fed. The Fed economists are really trying to present this story that things are going well, and or not even like, I mean, they started off with that. They kind of like backed off the things are going well story. But the first part was that the inflation was transitory, which is like, again, another bit of a shell game. Where the inflation is coming from, and then there was like this storyline about businesses were creating inflation. It's like, well, yeah, naturally, that's like, that's where inflation comes from. That's not like, that's intrinsic almost in inflation, that like the business is creating inflation. But the question is, are they the first cause of inflation? And I don't think that's the case, right? Like, I mean, if they could have been like absorbing more profit and alpha from people, they would have already been doing it. They're not like sitting around being like, now's the time to hit them up, And so I think that like, that's kind of the indicators that I look at. And I think that like, probably the people who are listening can like think about that themselves. Like, am I spending money? Am I trying to go out and buy new things? And when you see that slowdown, those are, because like you said, economists are oftentimes looking back at data, right? So like, they're like, oh, like this is what happened. And like, but we know right now, if we're trying to go out and buy a house or buy a car, and we know right now if like a business is trying to expand or if they're shoring up their capital for a downturn. So that's kind of like my take.
Well, and usually recessions can either come because the business cycle, the expansion and retraction is just sort of reached a peak, or there can be a shock to the economy. And we had a shock. We had like,
sure.
I actually was digging through because everybody wants to talk about recessions. I was digging through my notes and I found a show that I wrote in September 2019 that was called A Recession is Coming. Are you ready? And it was like all of the, yes, we know a recession is coming because the business cycle was leading there. We'd been riding high for a really long time by September of 2019. And there was every piece of evidence that something was going to happen to make us hit a contraction. And then everybody, in March 2020, everyone was asking me like, oh, are we in a recession? And I was like, I don't know if we're in a recession, but whatever shock we were waiting for, we got, right? There's right. there's no question about what influenced this. But I think for a lot of us, if you are in a part of the economy that's very volatile. So if you work retail, hospitality, if you have a business in those sectors, then you saw the effects of that shock in a very tangible way, right? Like a lot of businesses had to pivot. Like I just came back from New Zealand and my tour guide, who it was his 653rd tour or something to Hobbiton. He had done it for years. And he was telling me that, New Zealand was completely closed and he was acting as a courier. They had taken all of the seats out of the tour van and he worked as a courier for 2 years. And so like, if you're in a volatile part of the economy, you had no question that there was an economic shock. But if you were someone that had in a different part of the economy, particularly in one of the parts of the economy that got a lot of money pumped into it, or a lot of the other places that money was flowing ended up. So like, for example, you worked in a tech company that maybe you didn't get government subsidies, but the government subsidies were flowing around and people were looking for places to get return on their capital. So they started buying your stock. Like, people in the higher parts of the economy didn't really feel that squeeze. The only real place that they felt that squeeze was housing, and supply chain issues, right? Like I think all of us in some way experienced some kind of squeeze from like the chip shortage. You wanted to buy a new freaking washing machine or whatever, but like, housing was the only real place that we saw the top income earners really experiencing any kind of economic strain on their life. And the thing was that recession never even technically was a recession. That March 2020 recession that we were all like, well, the economic shock happened, because it was an unprecedented, as much as we all hate that word, crisis. There was a lot of financial tools deployed all at once, all over the world to put liquidity in the economy. And so we kind of pushed out that recovery. And I think a lot of the ways in which we pushed it out were K-shaped, exactly what you're saying. We essentially increased inequality in the economy. And now, this is my most common phrase, it's not a recession till the rich people feel it. And guess what? Rich people are feeling it now because the inflation has happened in all sectors of the economy. And particularly, it's happening in the places where rich people consume more, right? Because if you are low income, what do you spend the majority of your income on? Fuel and housing. And if transport and housing and food are the biggest sectors of your budget, you feel inflation a lot sooner than someone, for example, what do rich people spend a huge portion of their discretionary income on? Insurance. Well, guess what has gone up in the past couple years? Insurance. And like it took a while for that to happen. Like poor people don't buy that much insurance. Rich people buy a lot of insurance. Because
I think you bring up like a good point though, which is that like, sometimes, we're using super technical terms and like in economics, you have very, finite definitions of things. But for an everyday person, right, when they hear recession, like what does it mean to them? And it's like, well, like you were saying, like they can feel the recession. Yeah, they're like, I know that like I don't have enough money to survive. That's like, they don't need like an economist explaining like, well, we're not really in a recession. It's like, well, I don't have enough money, and the person next to me doesn't have enough money, and the person next to me doesn't have enough money. So I think that's like an important point. Is like, what is actually going on? So maybe like some of your thoughts, Kai, on like, to me, this non-recession.
It's interesting because some of the things that you want to be there to start calling it a real recession really are not obviously there, and that's the thing that makes it so complicated to talk about. Is like, okay, people have jobs. people still have jobs, and that's one of the criteria that everybody's always looking for, the economists and people in the investment world and the banks that also are out there making all kinds of calls in public about, is it a 2H recession? That Bank of America just said that yesterday, second half of 2022, there'll be a recession. Everybody needs to be looking at like, okay, do people still have jobs? Are they making money? And then are they spending money? So sales in aggregate and jobs are important parts of calling it a recession that are not obvious yet that it is truly bad. It's not obvious to me that those things are going that poorly. And you need companies, you need businesses classically to also be losing money. And I think there's that's something that I am very interested in trying to figure out. Like, are people still making money in real terms? Is the profits that continue to look like they're happening? How much creative accounting is happening to making it continue to appear that they exist? That's all becoming really interesting. And we are having this conversation at the very beginning of earnings season. And so we've just got a couple of earnings have trickled in, and they weren't great. I looked at Wells Fargo's this morning and and it was pretty bad. And I looked at JP Morgan yesterday, and it was cursory, not fantastic. And so we will see if those markers start showing up. And this is the first time I'm ever going to try to do this in a Zoom podcast. We're going to try to share a chart in real time instead of me editing it in later, and we'll see what happens. But this chart is an important one in that conversation, because we are talking about who is making money. Are profit margins actually collapsing? That's an important part of that conversation of like, is there really a recession? And the S&P 500 is pretty much even in terms of what share of companies are increasing or flat and what share are down. And you find a couple sectors are not doing fantastic. That's discretionary. So the Starbucks and Louis Vuittons of the world. Utility is somewhat surprising in some regards. And then financials, which are doing really bad in profit margin right now. But then you have enough weighted activity to the upside that we still can't really say like, this is truly what a recession looks like here. And that should matter to investors going forward.
I think there's like some question about how, so for me, there's definitely questions about how jobs are being measured, because there's like very different stories, and like this whole supply shock and the closure of a lot of businesses has been in some like really weird like metrics for like jobs, right? I mean, like I think we all kind of know the story of like people who were either on furlough or like they were collecting unemployment, and then like at some point that like that ceased, and I don't think that like the economy saw the surge of labor that we would have all thought would have happened, right? We see a lot of like open jobs and people looking to hire, and so that's like really I think like you were saying, it's like probably like one of the indicators. It's a little bit hard to get an idea of what's going on. It's definitely one of those. Yeah.
I'll also say that like economists are famous for like being like, this is how this thing works. These are the data points. And then something unusual happens and then they go, oh, except in this case, we have every bit of evidence that every time a unique financial economic event happens, we're like, oh, but then there's this other except the potato famine. Suddenly the basic of microeconomics and demand is thrown off. Like there's just a lot of ways in which we can't look at historical data to predict future results, and we know that we're living in weird times, and we're also like, this is the first global pandemic on this scale that has affected a globalized world. And because we're so globalized now, and there's so many knock-on order-on effects from that happen from this, I don't know if we're ever going to be able to say, oh, well, this is how recessions work, based on historical data, because we're not mimicking any historical events, right? There's a lot of evidence that when you survey people and you ask them, would you rather accept some inflation and have and high and low unemployment, or would you rather have high unemployment and no inflation? Everybody would rather have a job and pay slightly more for stuff, right? And like this is the one metric where like we're all whining about inflation because it's real, man. I cry sometimes when I go to the grocery store now, and I've been someone that's always been very capable of keeping my grocery spending the same. And it's just not possible anymore. Like I don't have my dodges. I don't have my like playbook to kind of avoid grocery inflation anymore, because there is no avoiding it. And we're all whining about it. But I also don't know very few people that want a job that haven't been able to find one.
Right.
So I just got back from traveling. Every single place I was in had a sign that said desperate for staff, we're hiring and or like we're short staffed, please be patient. Like, I mean, like the level of discord between the labor market and every other metric is just, I think we're just going to have to accept that happens sometimes. It happens when people are afraid to go work in a public retail environment during a respiratory pandemic. Like, it's things are going to happen. Right. It happens when we have like shocking and staggering numbers of people becoming disabled from a global respiratory pandemic. And like, it's just going to keep, I think we're going to keep seeing that the data is weird. I don't think we're going to find new, and I don't think we're going to get back to the same kind of data we've seen before.
Right. That's my kind of takeaway from all of the asset managers and banks and analysts that, I get to talk to on a regular basis, is a lot of them spend most of their time trying to draw analogies and say, Well, if we compare it to this recession, back in the 70s or the 80s, it's not quite like that. And there's this kind of fixation on saying, well, if it doesn't look like something historically that we can all reference as, oh, that was a recession and it looked that way, that it isn't one, which I think is unfortunate that there is that fixation. Like, this is probably a very unique moment that in the future will be one of those, should it ever happen again, where people will be like, oh, this is like 2022, man. This is, a future analogy that will be drawn because it's so unique to the world. And America was, in the last conversation I had with one of those asset manager types around this, they were bringing up the recessions from, the 60s and 70s, where America and the entire economy were completely fundamentally different. We were not a deeply post-industrialized service economy at that time. And so it looked very different in terms of also inequality. Inequality was much lower at that time. And it made it a lot less noisy in a lot of regards. That's one thing that I've been really most interested in over the last couple of years around these talks about, like, how is financial wellness going in households, and how's the economy going, is that there is a pretty astounding amount of inequality that's at historic highs, and it is still there, and it makes it really difficult to talk about in top-down terms, because there are plenty of people who are doing amazing, and right now we're the richest that they've ever been and have fantastic incomes, and that makes it difficult to talk about because then you have so many people who are not, they aren't heavily invested in the S&P 500. That is a pretty serious thing. And so, yeah, it makes it very noisy, like you say. And the data will probably, I think you're correct, continue to be really weird. And companies doing well. That's I had another chart I will share because this one is so interesting, and I just got it, and I've been preoccupied with looking at this one. And what this talks about is upgrades, downgrades of credit quality of firms. To me, as I'm reading this, the amount of downgrades is not nearly what you would expect for the middle of a recession. Usually when you're in the middle of a recession, you get a lot of firms having their credit quality downgraded because it's becoming obvious that the fundamentals are deteriorating. Their debt is soaring and their revenue is declining, and they're starting to make decisions that might actually hurt long-term viability to support the short term. And that story is not actually showing up that much here. We do not actually have like historical levels of corporate balance sheets being downgraded.
Yeah, I mean, I think like you guys both said, we have just a really strange situation. I think we all want to have a very neat definition of like a recession and like what's going on, and that's not always the case. And I think like one of the other factors to think about is just as you have a more successful economy and a more developed economy, your definition of failure is going to change, right? I mean, like it's clearly going to be different than it was in the early 20th century. Like, hey, this is this is where everyone's hurting. So for what the everyday person expects, and the expectation is a lot of economics, right? What the everyday person expects changes. I think that's really the concern, and probably why a lot of people are asking about the recession. Like, what should they expect? That's really what people want to know, I imagine, right? Like,
yes.
What is going to go wrong? What do I need to do to prepare for whatever is going to go wrong, right?
Right. I think that's a great segue moment to the stagflation conversation, because stagflation, to me, the reason people are so interested in it is that we are so used to the idea, even if people aren't voicing this directly, we're so used to the idea that the government will basically make sure we all have money, and then it will, calibrate, and it will reach an equilibrium and we'll all be good again. But stagflation is one of those conditions where the ability to do that is non-existent. And so it's in modern times kind of the creepiest variety of recession conditions, where it's like, well, we can't really spend our way out of the problem in the way that we've actually done very well in recent history.
I mean, in really recent history, we spent our way out of March 2020 by May of 2020, right? So, and I think that people get confused about what stagflation really is. And I think the most important thing to understand is, like you're saying, it's the inability of the Federal Reserve or fiscal policy to find a way to both stimulate the economy when the economy is slow, while keeping inflation under control. And because normally you've got the two levers, right? And the levers are like, if you spend money in the economy, if you, for example, print the most money you ever have because of a massive, unprecedented public health emergency, then what you do is you pour money into the economy, and that money, eventually the bill comes due in the form of inflation, because when you put more money out, you get inflation. The big criticism of the Federal Reserve and the current inflation targets that we are missing, which, because we always want a little bit of inflation in the economy, because that spending money is how you keep it going. The alternative to that is being Japan, which has had a deflationary economy for 20 years and nobody wants. It's not good. It isn't a good feeling to buy a house and know it is going to be worthless in 20 years, right? So like it doesn't make people invest in your economy. It makes businesses decide to go abroad instead of staying under your currency. So like, as much as we hate inflation on a personal perspective, it's important to understand the alternative is not great either. So they target a low level of inflation, just what we've magicked out of looking at historical data, and all the economists have put their little economist hats on, and they figured out, oh, no, there's this low level of inflation at which we can accept, but the economy still grows. Stagflation is when the economy stops growing and you also have inflation, because it means we can't spend to get out of it, because it'll keep raising inflation. And the big criticism was that the Federal Reserve, which pulls the other lever that isn't the spending lever, but pulls the interest rate lever, took too long to raise the interest rate lever. And because they took too long to do that, that is part of the reason that they're kind of in this like absolute like panic mode right now, where we're seeing these like massive, by American standards, percentage point increases of the Fed, Fed funds rate and of the discount rate each quarter. And it's just because like they're freaking out.
Right, they are, yes.
I think that's exactly right. Yeah. I think that the case is that like the Federal Reserve for the last 2, maybe even like 3 chairman have thought like that part of their mandate is now to prop up asset prices, or maybe they just don't like the negative publicity, but they have been unwilling to raise interest rates to what people would even nominally unpopular rate, to nominally unpopular metrics. So I don't know. I think that's really part of the issue. And you're right, they dropped the ball, and now they're like, and now they're looking around like, oh, what do we do? We don't want to cause the recession. Okay. All right.
Right. Well, and they're also the Fed, so they can't actually say we're freaking out, because if the Fed says we're freaking out, then everyone freaks out. And that's like, so they're saying it in their Fed way, which is like, we have decided to raise things 75 basis points this quarter in order to, because they can't we've learned what happens when the Fed, that we dealt with this in 98. It turns out when the Fed says something that is just a little too emotional, then the animal spirits in the market go freaking out. So, but we're already seeing I think that the reaction that we're seeing in the business community and a lot of the reactions that we're seeing about, proclaiming the dark times and a lot of the asset prices drops we're seeing, I think very much are the animal spirits responding to the fact that they've gotten so used to cheap money. I mean, we have gotten so used to cheap money because our rates have been so low for so long, including prior to this pandemic. I mean, we still had really historically low rates. And it turns out just any itch of being like, oh, maybe it won't be 0% now, makes the businesses really stressed out because they've been operating in that environment for so long. And it's a little frustrating because sometimes you want to tap them on the shoulder and then remind them that during previous booms, we have in fact seen higher interest rates. And it turns out it is okay to have higher interest rates. But we like cheap money. I mean, who doesn't like cheap money?
Yes, we are addicted to that. And then also the Fed I think the Fed has got so much attention this time around also from a unique phenomenon that has become way more intense, which is political tribalism level that exists now makes the fiscal solutions almost impossible. Nobody even is talking about like, oh, well, what could the entire fiscal side of things done differently, or what could they do going forward? Because we know that there's almost nothing. They probably will not actually be able to agree to almost anything, and so you can't,
including continuing doing what they have been doing. I mean, like that's what's phenomenal is that that part of, I think, the uncertainty we're seeing in the business market right now is actually uncertainty over the fact that the fiscal policies that do not extend, that don't automatically renew, those things are drying up because we can't get anything passed. Right. And so if we can't get anything through, and we're not even renewing programs for AIDS drugs that have been continually renewed since 1992, then what are we, what hope is there for money that is maybe I hope less controversial, although let's not get into healthcare and controversial.
I think that brings up a really good point, which is when we get away from the more technical definitions of recession and we talk about what are people really asking, they're asking sort of these similar questions about the uncertainty. What can we expect from the financial markets, given that there's political uncertainty is just huge right now. And again, I probably have the strongest opinions about the Fed, but I think that they have not done a great job at being very responsible, and even they've become somewhat politicized. And then we have, Chaim said, political tribalism. So we don't have a lot of certainty there. And so what kind of things can we expect from the markets? And it's but even the markets don't know, even they're we're not really sure where this is going to go. So, that's my 2 cents, guys.
Right.
You pretty much just summed up everything we talked about in about 2 sentences. So great job. Yeah. Chaim, do you disagree with anything that Pablo said? Because I feel like I agree with you. So I'm curious to see if there's anything that Chaim doesn't agree with in that kind of.
I agree with that summary. That to me, I think I focus on a lot of things in this cycle that are. Like I said, a lot on inequality, a lot on fiscal, that's the thing that bums me out in this kind of current conversation that we're having, is that we're pretending that fiscal solutions don't exist because we're, granting the premise that they probably can't happen. That bums me out. And I think it also bums the market out tremendously. And that's why onto that expectation point that you're talking about, geopolitics in our world, the investing world, the finance world, had been like a non-thing for many years. Every year I have gone to the geopolitical risk summit that a couple different asset managers put on. And usually nobody shows up. Usually there's like the very few people who are like me. Like I was a Russian history major, so of course I want to show up and talk about geopolitics. But here it's like, well, politics, our cycle, the midterm cycle, is hanging over expectations with the market because the market would love to believe that magically the elections will produce an outcome that could create a fiscal solution alongside the Fed's efforts. Like that would be the market's like absolute favorite outcome. They'd be like over the moon. So our midterm cycle is just kind of hanging over things. Like I've been telling people, it's really hard to expect the market will get excited again until that's more or less cleared up. And then Russia, Ukraine also hangs massively over this entire conversation. Because in reality, there is so much of inflation that is coming from geopolitically sensitive commodity flows that a huge war in Europe is making it very difficult to reach any kind of equilibrium. It just will until we have some clarity on that.
That's another example of the this time can't be the same as the past times. It's just it's like this is going to be unique no matter what, because just like all of the other historical events that we look at in the economy, it comes with its own set of circumstances that are unique. Like, we spend a lot of time looking at like the post World War II boom. And it's like, well, we're not going to recreate those circumstances, right?
Let's try not to. That's probably for the best. Yeah. No, I think it brings up like a really good point, which is that we have often dealt with economies that are super siloed. And then as everyone talks about globalization, we think about how interconnected we are. We could see that through the health crisis. But one of the points is that, if you think about just Europe's economy and what they're facing, I mean, if you're in Europe, you for sure are facing a recession on pretty much any metric or standard that you want to call it by. You have a war on one piece of your economy, and so I think those are the kind of things that make it again difficult for us to define in the technical terms, but clearly we all see that there's issues because all of these different countries, China is probably facing a recession, and so there are so many interconnected pieces for us to say well, it's not going to be technically a recession, but you are probably going to have higher interest rates, and then you are probably going to start to see less spending or whatever the factors are, that's kind of I think how do we, I guys want to know your guys' opinion, how do we approach this, these sort of risks that we see, and what kind of risks do you guys think that we'll see in the future?
I'm very interested in minimizing the expectation of risk in personal investing, simply from the perspective of, I think it's very easy to get caught up in these macroeconomic cycles and influence decisions that should not change with regards to your own personal portfolio. Sure. I think it's really easy because who hasn't been stuck in the doom scroll mindset? And now that's in the economic cycle, right? Where you're war, fuel crisis in Britain, freaking Boris Johnson resigning, the level of, you can just stack uncertainty onto uncertainty. But there's still certain things that have not changed about your financial position. And I think I see this especially amongst business owners. I think Chaim was saying this, where, you have all these business owners that are doing quite well in their own businesses, but then acting like the recession should change the way that they are approaching things that aren't asset allocation in their portfolio. It's totally. If you're a regular investor, especially if you're mostly looking for investing at your own retirement and you're going at a long scale, you're not close to retirement, your dollar cost averaging of how much you might put into your portfolio now and how you allocate it is not significantly affected by these near-term events. If it was a good investment, like for the long term 5 months ago, it's a good investment for the long term now. And so I think it's important to not get too caught up in the short-term thinking, because like that's how you stay poor, right? Just in your own budget. Like if you're thinking short-term and you can only think short-term, then you are trapped in that like poverty mindset cycle of like, I'm going to buy one toothbrush for $10 instead of buying a 10-pack of toothbrushes for $20, right? You know, and I think that's exactly how a lot of us are approaching it, because it's too freaking overwhelming right now. And so it can be really easy to be like, well, I shouldn't do anything. I should spiral. I should pull all my money out of the market. I should, you know, I should spend my emergency fund on beans. I don't know, whatever your panic response is, go to Sephora and spend $500 on nice lipsticks. I don't know how, no judgment. We all have different responses, but
that's
like,
my panic response.
Yeah, exactly.
I think it, like,
right?
I think it brings up like,
hey, lipstick sales always go up in a recession. It's fun fact.
Another great point. I think that maybe Chaim can speak a little bit too, which is like, I think if it was me personally, I'm thinking about like the people who are most at risk are people who are looking at retirement over the next few years. You know, I don't really see us having any stability until like 2024 or 2025, you know? And so those are if I'm in that bracket, that's where I'm really concerned about, like, how can I make sure that inflation is not eating up my returns? How can I make sure that my retirement's, you know, is going as planned? I don't know if you have any ideas about that, Chaim.
I think my main related to that, and also just thinking about risk and how that's going right now. The interesting thing is this is one of the worst moments in the entire history of asset allocation. A portfolio that is a 60% stock, 40% bond mix, which has always been pretty reliable, is having one of its worst years, if not the worst year in its history. And so a lot of the risk management tools that, you know, people like me rely on in portfolio building are actually not working. They are just not actually functional at the moment. And that makes that retirement bridging question more important, because that traditional approach of, well, just have more bonds, like those you get to the horizon, and it's one that, you know, I've used for a very long time myself. You know, if you're in bond funds, those are doing very badly. Those are in a pretty bad spot this year. Double-digit losses for short-term high-quality bonds is not feel good. And also international. You can't really rely on, I'll just be internationally diverse to diversify away risk. Well, international has done broadly much worse than the United States. And so there's not a lot of places where you can look to say, well, you can manage the risk by going here or going there in the way that traditionally you do it as a portfolio manager. And not a lot of like flight to safety trades, and cash itself also, with inflation being so high, you can't say, well, just hang on to cash, man. Well, you're definitely going to lose money if you do that, and you probably lose a lot of it doing that. And so it's basically the main thing that I'm focusing on is getting people to not sell their bonds, because for some reason people have this weird thing about market timing where they know, I can't sell my stocks when they're down. Like, I know that's a crazy idea, you don't do that. But for some reason people have a different response to the bonds market. They go, oh my gosh, this thing is supposed to be safe though. And so I can sell that one when I've lost double digits amounts of money. And so that's like one of the things that I've really focused on in conversations about risk with people is like, yes, I realize bonds are in a 2 standard deviation from the norm move. And that does not mean that you sell them because in reality, you're probably going to miss out on any recovery that happens in them if you do that. And recovery does not look impossible for all the stuff that we've talked about. We're not in a like true doomsday scenario for the economy. We have raised interest rates for once in a very long time, and that freaked bonds out. But in reality, they're probably going to have to cut the rates at some point in normal regime of interest rates becomes a thing again at some point. And so selling off your bond portfolio really doesn't make any sense in that scenario, because well, if you keep buying bonds and you're averaging into them just like you do with your stock positions, well, the new bonds that you're buying right now are the highest yields that you've had from bonds in a very long time. So that's actually kind of a positive to me in some regards. And so, yeah, I focus on like, okay, it's very difficult, I understand, to point at bright spots and say, this is my reserve that I'm going to use to buy, bonds are up so I can buy more stocks while they're down. That's not a thing this year.
Right. I'm curious, like from Lillian, like, so what do you think are like sort of the young people and young professionals' concerns right now, given that like, we don't really see that, they're going to have a risk. If they have good financial planning, they shouldn't have too much risk, because by the time that they're retiring, things should have like stabilized. So what kind of concerns have you heard about, or what kind of concerns maybe like have you yourself have about like the lack of stability beyond like, those concerns that we all have, which is just like, well, the government's not working as well as it should. You know what I'm saying? Like real financial concerns. I'm like curious about.
I think you were asking like, what do you think kind of the younger folks that I've heard from, like, what are their concerns?
Yeah, what are their concerns? And I was thinking kind of what you're talking about, like in terms of, you're talking about the small business and they have concerns, which I think if like some of the people listening could better understand, and I think maybe at this point we've sort of described some of the quote unquote like recession issues that they might face, that I don't think that people would be as afraid. I think that's a large part of it. So like, I was curious, like what kind of concerns have you heard? Are there things that we can address or talk about? That would be great.
I think a lot of Chaim's like discussion of like how to react to watching bond yields falling, I think for the more technical side of things, I think it is really important. But I think actually it's way more visceral than that, is what I hear. It's not like bond yields are falling. How do I get the right allocation to my portfolio when both sides of my portfolio are down? Like that's like more technical level than really what I'm dealing with. Like a lot of what I'm hearing is just like, why would I continue to put money into my 401k or my investments each month when like I get depressed every time I try to update my net worth because it's going down? Like when you log into Personal Capital and you're like, oh, that's a down arrow, right? Because for a lot of us, we had gotten really used to the past couple years of just being like, especially even in the like financial media space of like people that are like, amateur personal finance bloggers that love to post their net worth updates. It's been real quiet the past 6 months of people updating their net worth numbers. And
it reminds me of like sometimes you see like cryptocurrency, like crypto bros are posting their returns for like a long time. And it's like kind of a similar thing. And I think that you like just hit the nail on the head there, right? Like the real concern is that people are disinvesting or not investing when by most people's standards, like again, unless something so drastically changes the world order that we have other issues on our plate, they should be investing, because these things are going to pass. Sure, the stability sucks, but it's really like, like, as you mentioned before, it's when it hits the wealthy people's pockets that like we get to see it in the media and the news. And honestly, like I feel for them. I do. Maybe they won't buy their second yacht, or maybe the hedge fund won't make the kind of money that they thought they were going to make. But I think that like, people need to be reminded to continue to invest in and trust in the system. And if the system does fall apart, you won't be able to find any of us to hold accountable, because you won't be able to find anything. So,
right. Well, and I also think that like the fundamentals of personal finance haven't changed. While we keep talking about how like there's so many unique things about this recession, there's so many unique things about this like economic shock, at the same time, like the fundamentals of your own personal financial wellness, especially if you are not close to retirement, is they haven't changed, right? Like being able to know that know what you have coming in and what you have going out, like having an emergency fund that is proportional to the amount of risk that you have to your income. Like I see a lot of people made a lot of criticisms of, like, for me, I had a very high emergency fund, and those all disappeared in March 2020. Nobody was like, oh, it's ridiculous that you have a 2-year emergency fund, when I was like, but I understand that my like income is very stable, or my income is very unstable. And like in March 2020, in one day, I had like 6 months of income dry up, right? Because I do a lot of stuff that requires me to do public speaking in person with people. The other money I rely on is exactly the kind of thing that dries up on the recession, which is that a lot of the money that I get is from advertising dollars. And guess what dries up? Advertising contracts, right? So it's like I always understood my own level of risk, and your personal finance is personal. And I think there's a lot of people that get caught up and they doom scroll, they read, they hear what their cousin's aunt's sister-in-law is telling them about the real estate market. And they have decided that indicates their level of personal risk. But in reality, you know, a lot of the stuff that affects you, you know it better than anyone else. And, there's only so much talking heads can tell you about your own personal financial situation. And like, there is a value in reapplying the fundamentals when you are uncertain. So like, because you are scared, instead of trying to get weirder and weirder with how you respond to it and swerve and do things like invest in speculative asset classes, for example, crypto, instead of trying to swerve by doing something unconventional, there's a lot to be said for like going back to the basics of, do I have enough emergency fund? Do I have a plan for how I'm going to make money in my business if this large contract dries up? Like, you know, where am I putting my energy? Am I putting my energy in my business or my own finances into a place that's extremely volatile, or am I putting it into a place that always gives me returns? Like, does it always give you returns to like go to the farmer's market and buy your vegetables in bulk? Or does it always give you returns to like, you know, be running around town chasing down CVS extra care coupons? Like, you know, whatever it might be for your own circumstances. Because I think things got so weird and things were so uncertain for so many of us. And the returns were so bananas because there was just so many abnormal things about the way we were spending money, about the way money was flowing in the economy, that a lot of us got real caught up in trying out a lot of the spending more time and energy on the things that should be a very small proportion of what you do with your money. Like, it's fine to have play money. It's fine to do individual stock investing, to have some speculative assets, but because things were so uncertain, I think a lot of us got really caught up in like tracking that as though it was replacing the fundamentals. But in the end, money coming in, money going out is like more important than any of this other kind of stuff. And I also think that also became true with a lot of business owners that did receive government assistance, that got emergency funding, that were jumping their way, trying to pivot. They were just going from fire to fire and crisis to crisis, and also like constantly dealing with like bureaucracy nightmares that so many of them actually are now dealing with the like, okay, but if this is a normal recession, like if this is normally what happens when business gets slow, do I respond in the same way that I would have before the pandemic? Or do I go back to that complete fire jumping scenario that we were? And I like to put less stress in my life, not more. And so generally I find going with the thing that is going to produce less stress and has more guaranteed results for me is the way that I'm going to do things. And that's the way I'm going to do things with money. That's the way I'm going to do things in my business. I'm not going to be like, let's set something on fire because everything's on fire in politics. Right. So
no, that's exactly right. I think that like going to fundamentals, I think that's part of like, what that really kind of explains the story of what's happened in the last like 2 or 3 years. You know, like we've been saying, like what we have a hard time defining it, but like it doesn't mean that like the fundamentals have changed. Like I said before, the same with investing, and you were talking about like financial planning and personal planning, like it's the same thing. Like the fundamentals are the same. So if you're a small business asking, what should I do in a recession? Well, you should look at the sort of fundamental things that you would normally do. Like, hey, how can we cut some costs? How can we prepare it? How can we have a rainy day fund? And I think that like sort of reassuring is a lot of what people need when they ask about what should we do, because things have been so, like, I don't know if you want to call them novel or original. Things have been so different than they normally have.
They've been so
exactly.
spicy.
Yeah, exactly. Yeah. Getting real variety here, that like people think like, oh, maybe I should do something new. And it's kind of also been my life experience that don't try new things when you don't know what's going on. Try new things when you can afford to try new things. Trying new things when you're like in a sort of like, deciding that you're going to get into cryptocurrency or you're going to become like an options trader, or like, my investment plan of buying $20 worth of lottery tickets every week is not a good idea. It's not the way you should handle uncertainty. I'm sure that Kai has some like thoughts on that also. Yeah.
Well, I think like you and Lillian like definitely hit on an important dimension that I see in my conversation with clients about this condition, which is people have this perception that like, oh, this time is different in a way where I need to be worried about an extreme circumstance that will come out of a recession, not just that like, I'll have less money, I'll be more poor, I will put more on my credit card, that's a normal recession. Hopefully that all, we all are entering into bad economic conditions with like the expectation that like, okay, it's just like, it's normal for business cycles to happen. But things have been so zany in American life in recent times, and so intense in terms of the amount of tragedy and catastrophe, and then catastrophizing. The people are catastrophizing the recession, in my experience, of like talking about, okay, like let's do some negative visualization of like what's the baggage around it being a recession, because those conversations have revealed a lot about like what people are really worried about is not just like a recession. 100%. It's like, oh, America will end, China will, will be at war with Russia like next week. Like all that stuff is so much noise on top of this conversation of like, is it a recession? People, it's not just like, is it a recession? It's like, is this the big one? Is this
right? Is this the beginning going into a civil war? Is like, what's going to happen?
Is this the end?
Exactly.
That's a question that people often are really asking when I spend time like getting into it.
It's really hard, right? Like it's very hard to be a human in this time. And it's like, it's even harder to be a human with access to Twitter, right? And I think there's so many of us that are like, we're just left being like, it just keeps coming. And so it's easy
every year.
It just doesn't stop. Like,
I don't know if you guys had this experience, right? When like the new year came, you thought like for some reason, like it's a new year. Things are good. I remember, so it was like 2020. I'm like 2021, and I was like, "What? Why is half the earth on fire? Like, what's going on?"
Yeah.
So, but I think that like we've all decided to come up with apocalyptic designation for finance. So any listeners who want to get in on that, we're gonna tell you where to bury your.
We will have all the hay boxes and rocket stoves to go with your bond funds.
Yeah, exactly. Yeah.
Lowest premiums on silver. Number one preoccupation of the true catastrophe advisor. But that's an important dimension of talking about this. Is like, I've had many of those conversations where I go, like, there's something hanging over this conversation of like, is it a recession? It's like much more intense than is it a bad moment in the business cycle?
Hey, we all, I think it's important to like recognize the power that economic trauma that a lot of us have gone through. So like, there's the economic trauma of the past 2 years, which it was for most people was short simply because if you're in the United States, we had a lot of tools at our disposal to help people deal with them. Right. But there's also like my generation like graduated into a historically bad economy, and like I worked 5 jobs for fucking years. Like I don't want to go back to that, and I'm like, I don't want to go back to living in a geodesic dome I made of cardboard. It was cool, but like I have a worse back now, and I just do not want to have to sleep in a cardboard dome. And like I think that like there is a lot of trauma like my generation has, and then the slightly older generation, me, that remembers of stagflation in the 80s. And like, if you were in the tech industry for the 2000s bust, you're kind of like the way that you're approaching things now, you're kind of we are holding that trauma, and that trauma informs our actions, but trauma also makes you make freaking irrational decisions. And you have to step back and go like, is this the inner voice that tells me, like we call it on the Oh My Dollar forums, we call it your inner bag lady, which my inner bag lady is always driving me to make completely irrational decisions because she believes that like it's always going to become the worst. Like I will be on the streets eating cat food out of a tin, and like it doesn't matter if none of the numbers line up to that. It doesn't matter if I have social support that indicates that I will not be living on the streets eating cat food out of a tin. There is always the inner bag lady in there. And she wants me to like, oh, don't throw out that Ziploc bag that has a hole in it because you could still use it for certain things. Like, that like the inner bag lady's in there, and she's got a couple of those levers still. And only therapy can fix that, which is, unfortunately a large part of financial planning.
But I think that what you guys have both touched on, which is super important, right, is that that a lot of these fears about recession are actually some other sort of fear, like how do I approach things? Because if if you're Phil Knight at Nike or something, if you're the head of GE, you're not too concerned about a recession. You're like, we're going to make money next year and the year after that and the year after that, right? And so one of the things I think that people can do, whether they have financial planners or financial advisors, et cetera, but they can sit down and find out a list of their priorities. What is it? And we have unprecedented tools. Again, like in this day and age, you couldn't imagine being really a digital nomad like 20 or 30 years ago. It's like much different. How could you work remotely, and so many things that you can do. And so I think that one of the things to address is if you are that person who maybe is working in the service industry, what are your priorities? How are you going to yourself feel secure? Are you going to say like, all right, well, I can travel and work at different service industries? Am I going to change careers? Am I going to have a higher expectation of my employer about how secure my job is and things of that nature? So I think that's really the key is what you guys, the personal experience, right? I mean, we can talk about the larger experience, but I mean, it probably doesn't make anyone feel any better to be like, well, it could be a recession, but it might not be a recession. and it really depends on when the NBER comes out and says it's recession. I don't know if that, probably nobody cares about that, right? So.
Right, and nobody cares if it's not technically a recession if your rent is going up 25% year over year, right?
Yeah. I mean, and that brings up another, I do think that travel and geography and moving and things that which a lot of people have been doing is just something that people need to take very seriously, because I do think that we're facing very different political environments and financial environments in different states. Obviously, from all the news that we've had in the last couple of months, people are facing very different realities. And when you feel secure about those realities, I think the other problems start to line up. When you feel secure about that, you can start to solve that problem of okay, I want to make sure that I'm going to be able to retire in 10 years, or I'm going to be able to retire in 15 years, et cetera,
Yeah. Right. I think that's possibly the most important note to end on, which is that money and all of this finance stuff is just a tool for being able to actually live your life in a way that feels safe and secure and fun and is what you want to do with your life. And it's so easy and fun to get caught up in the economics of it and the asset allocation of it. But in the end, right, money is just a tool, and it can be used for good and it can be used for bad. And what you want it to do is to use it as an expression of your values. And that value is however you want to live your life. And I think that, all economy is personal, all recessions are personal. And figuring out how you're going to approach things and how you're going to react to things is more important than figuring out how much the Fed funds rate is increasing, right?
Yeah.
Because it frankly doesn't matter. Like if you don't have bodily autonomy, you don't give a crap that the Fed funds rate has gone up by 0.75. So I think, you know, in the end, think about your own values and your own priorities when you're sorting out how you're going to approach your money and how you're going to, you know, weather this recession just like the next one. Because I like to believe the world is not ending. But if it is, it won't really matter anyway.
Yeah.
So
do we have 3 votes for the world not ending? Is that correct?
I think the world is probably not going to.
If I get a choice, if I'm predicting,
yeah, vote for world not ending. Not that it will be a normal recession. I literally have no idea what it will actually feel like in the middle of it. But you know, not being too neurotic about it. I'm talking to myself. I'm probably the most neurotic person out there. Not being too neurotic about it, it helps you notice when it stops being a recession and things stop being bad, which is really important too. Is to not be so focused on macro predictions that you can't pay attention to things actually going well, because a lot of things do that.
And also, a lot of macro things have been going real well for the past 2 years, but literally nothing in real life has been going well, right? Like if you measured my stock portfolio vis-a-vis how I felt optimistically about humanity, it would be an inverse teeter-totter these days.
But we are doing better than maybe the people from 200 AD. So I'm going to give us that. That was a harsher life. I'm just trying to see the lining.
I have vegan donuts, so exactly. What else can we really hope for?
And I think hopefully Lillian will join us again for another podcast. It's been great to have you on for a conversation.
Oh yeah, I'm also part of. We didn't actually mention that at the beginning, but I'm now part of the
You are a actual advisor of Chaim Investment Advisors, and therefore should definitely be back.
We should be back for all of them.
Yeah. So if people are listening and they are in the category of folks that are looking at retirement plan solutions, that is what I am specializing in, to take off the plate of Pablo and Chaim. So if you want to talk about retirement plan solutions, you know how to find us. Because you found this podcast, so you know how to find us.
And I look forward to lots of more conversations with the three of us, and a fun conversation. Hopefully, fun to listen to, and fun to have a new voice. And I think that's a good place to leave it, because we have said a lot about recession and other stuff. And let us know if you liked this and feel good about it, and other stuff you want us to talk about. Because most of the topics really come from somebody saying, Chaim, you should talk about that. That really is where most of these come from. So keep giving us those, and we'll do more of them, and probably do a lot this summer. This spring we were not really recording very much, and so we're kind of actually back in the groove, posting stuff pretty regularly, and that'll probably be the case because things are a little more chill, and we'll have more of these.
All right, cheers. Thank you for having me.
Cheers. And this has been the Chaim Investment Advisors podcast, signing out, and Shabbat Shalom to all of those who observe that. Not that you're hearing that simultaneously, but excited for that to happen imminently.
Yeah. We'll talk to you guys later. I'm in the viewers. I'll talk to you guys probably really soon.